2025 was a year of two halves in financial markets, one shaken by tariffs, followed by a massive relief rally. But can that boost continue in 2026? This time last year, markets were positioning for the new Trump administration, largely betting that tax cuts and deregulation would offset the downside from unpredictable trade policy. That has turned out to be broadly right, with the S&P up about 15% year to date, led, as it was last year, by the Magnificent Seven tech firms. Well, Aoifinn Devitt is Senior Investment Advisor at Moneta. Aoifinn, after a tariff wobble in April, we've seen more and more bullishness in US equities. Can it continue?
We have seen resounding bullishness in US equities. It's almost a little alarming not to see a single voice, a contrarian voice in there that is sounding the alarm bell for recession. Remember, we've had recession forecasts every year now, it seems, for the last 4 years, and we have dodged every bullet and have continued to kick that can down the road. Some of the excesses that have not been washed off, essentially, with the recession remain. And we know that there are some precarious, I'd say, financial structures in place, a lot of borrowing in some segments, and a lot of consumers that are quite exposed now to these concentrated equity markets. So it certainly was a surprising resilience we saw in 2025. But 2026 will be equally interesting.
We've seen a lot of hand-wringing in particular over big tech and its spending on AI and data centres. How long have those companies got to show shareholders that spending is paying off?
Shareholders seem to be getting increasingly impatient, I'd say, to see evidence that the spending is being well spent and it is based on data. We know that the Fed is data dependent. We've spoken about that for a while. Now everyone is becoming data dependent. Data should be readily available, and we should be able to see proof points of some of this expenditure. We are far from having proof points in terms of the true impact of AI's effect on productivity across different sectors, and that is what will drive spending. And what we do know is that affordability is this sort of the siren cry of politicians today in the US, and affordability also translates into spending on AI. There will not be an unlimited deep pocket for corporates to spend on every LLM that comes out the door to try them. They will start to become more discriminating. They will look for the lower cost option. They will look for something that meets and optimizes their needs, not necessarily that fits, it keeps everybody satisfied. So I'd say we're going to see much more choosy consumer behavior when it comes to AI, and that will lead to more demands for more evidence.
Could this be the year that investors finally move away from that tight concentration in tech stocks in the US market?
At Moneta, we've actually already seen a cycling out of that tight concentration. We welcome it, because if an investor stays with that tight concentration, they will have a more volatile equity portfolio. No two ways about it. If one single stock has a market cap that equals the entire market cap of the UK, and that stock can move 10% in one day, which we know Nvidia can, then it means a portfolio will look quite different. So we have been cheered to see investors cycling not only into mid-cap, small cap, into other sectors besides the big tech, but also quite, I'd say, enthusiastic about investing beyond the US. If they're US investors, they've always had global portfolios if they're outside the US.
And interestingly, Eurozone stocks have outperformed the S&P this year, and so has the FTSE 100. Do you expect that to continue?
We would not necessarily expect them to outperform. We do expect them to participate. We know that US exceptionalism was kind of coming in and out of vogue over the course of 2025. There were some sell-offs, and there was that surprising participation by non-US markets in the upswing of US markets, even though their fundamentals at a company level and at an economy level were quite different. So it was nice that they participated in that. We talked about the return of more discrimination by investors in 2026. They will start to look hard, I'd say, at the margins, at the earnings, at the forecasts, and at the backdrop, the economic backdrop of the non-US stocks. And they'll see probably that the fundamentals don't stack up in quite the same way. But I do expect to see some positive returns there.
Could geopolitics upend this broadly bullish picture? Where do you see the biggest risks?
We examine geopolitics primarily with a view to seeing the impact on a portfolio. Obviously, there's massive human toll of the conflicts and some of the geopolitical surprises that we see. But what we've observed in markets is there has not really been much correlation at all between market performance and, say, geopolitical surprise or negative surprise, more importantly. We do see the impact on the oil price from time to time. It tends to be short-lived. And we see some sell-offs within countries. So something like Russia, clearly that's a one-off, one area becoming wholly uninvestable. We did hear rumors of that with China, but it now seems to be firmly back on the table as an investment opportunity. So geopolitics don't affect markets. That's not to say they don't affect sentiment. They do add to the flooding of the zone. They add to the sense of uncertainty, the sense maybe of a need to build resilience when there is geopolitical uncertainty combined with economic uncertainty. So it will probably affect sentiment, but we don't expect it to upend markets in 2026.
That was Aoifinn Devitt of Moneta. Don't forget you can watch more videos on Reuters.com.